So when we're coming into a release like this, we obviously always mark the market maker's liquidity. And what you'll find is the price will always be in the middle of those two key price prints. You'll find the price sticks to the middle. You can see that as the price sticks to the middle, of course, that's what's called fair value. On a short-term narrative, that obviously means that that fair value read is between 68, 66s and 65s. Well, no surprise then, right? 64.5 fair value read just now. And that's exactly what you would have expected because that's where price is at, 64.5. This is what happens on a small micro markets. That's called the mid price. So if I'm bidding 10 and I'm offering, if I'm offering 15, for example, the mid price is 12.5. That's the fair value price for a buyer at 10s, and it's a fair value price for a seller at 15s. The mid price of 12.5 is what that trade is. That's what the mid price is, right? So that's why we call the mid price fair value. Now, obviously, we've got to try and recognize if that outside market changes. If we start seeing that outside market changing, then obviously going into the release, then we can obviously start watching for this line changing direction. In other words, if they pull all the liquidity off the 65s, well, that's obviously going to, and they put it down at 64s, that's going to shift the fair value down and bond oil prices will drop. So the best way to do that is just to not put in the big thick lines because you can't see whether that liquidity is getting pulled. It's to put in smaller thin lines so that you can see whether that liquidity is getting pulled. So you try and keep the lines as relevant and up to date as possible when you're analyzing these things. So you're obviously trying to keep it relevant because obviously that way you can see whether that liquidity gets pulled away. And if it gets pulled away, where does it get added back in? We can see where it gets added back in. We can see that this liquidity here is obviously quite significant. Just now, there's no such liquidity on the other side of the book. So we can see that there are some significant sell levels in this market just now, isn't there? Some significant sells, 1, 2, 3. There's really only one significant buy trade at the moment, and that's at 65 evens. What does that tell you? Well, that tells you that the market just now is favouring the short side of the book. Why? Because the weight of money is on the short side of the book. So at the moment, that's what this tells us. Now, obviously, as we get closer to the release, we'll get more and more information. And obviously, we are still a good 10 minutes ahead. So this liquidity isn't going to start peeling away from this for a little bit of time yet, usually about 5 minutes before we'll see that liquidity vanishing almost entirely. Now, that's not a change in the big drop in liquidity. That's somebody's added a whole wad of liquidity at that price, haven't they? What price? 54, 55s. They're trying to put a bit of business done in there, and that's obviously caused that spike in activity at that stage, haven't they? So you start to recognize the obvious. And if you start to recognize the obvious, you can trade stuff, right? There's obviously going to be opportunities. At the moment, there's no trade because we are at fair value just now. So the price is just trading along fair value, quite the thing, not doing very much. And we've got a bottom edge 65, a top edge 66. And we've also got some liquidity at 66.40s. Remember what we talked about the other day, what makes price move? It's not deltas that make price move, is it? It's not deltas. We've seen many times positive deltas and the price goes down. We've seen negative deltas and price goes up. I mean, it's not unusual to see that. So it's not the deltas that make price move, and yet the order flow people always go with that storyline. Delta buyers, delta buyers, delta buyers. You've got to be long. Well, yeah, it makes sense, except of course if you're buying right into a huge commercial sell operation. So it's not the deltas that make price goes up or down, guys. It's the liquidity that makes the price go up. And we did an example of that story in the classroom a few days ago. We'll remind everybody of that story. It's relative value that makes the price go up and down, isn't it? It's that idea of what everybody thinks value is going to be. And we'll do a mind exercise just to make sure that everybody kind of understands that part of the process. Another top edge sell on the Nasdaq. Good sell. It's scratched out, unfortunately, but it has changed now direction. So you're obviously now on the bid hunt, and there has been a little prior bottom edge, cheeky little bottom edge to get into your first buy trade if you're interested in buying early into these moves. So you can see the next sell trade was the top edge of the prior highs. That sell trade comes in and we get a very, very poor response, but we're already recognizing the change taking place on this candle with the moving average. So based on that, we can look to the left and we can see obviously that there is a possible level here. We're well away from the blue, so that we don't have to think about the fact that we have to go all the way down into the lows here to try and find a pivot price, because that's not going to happen. So my job is to try and get into a buy trade for the squeeze higher. And obviously that squeeze higher has actually worked out quite nicely. So it's trading relatively nicely at that stage, based simply on this process. Now, we obviously can add in things like the banker bets into this narrative as well. We can ask the question, is the banker bullish or not? And obviously if the banker was bullish, which it was, you can start to recognize that you'd never have sold this one in the first place. Agreed? As a banker bet trader, you can now do two things. The first thing is recognize that the Dow trade is still short, and based on the fact that the Dow trade is still short, where would you be looking to buy the market if you're trying to develop out this process? You'd be looking to buy the market at the lows, right? Because there's no other place you could buy the market, correct? There's no other place. So when the Dow seller is still in place here, but the value buyer is coming in, we know that the buyers of value are always going to be located at bottom edges. So there's the buyer of value coming in here. There's the buyer of value coming in here. So you can start to develop out ideas based on the Dow trader and value. You're not held hostage to what the banker says, and you're not held hostage to what the Dow trader says. You're trying to build a story around the two of them. And based on the two of them, the buy trade would have been here, the buy trade would have been here. You would have taken profits here, because obviously that would have been a sell for the Dow trader. Now it's not a net short position. It's a profit take for the buyers. And then your next trade would have been a buy on an add-in down here. And that buy on an add-in's actually gone very, very well. Thank you very much. Adding to your Dow trader, adding to your process as a Dow trader, you can start developing out some real quality narratives, guys, real quality narratives. And we'll be talking about that in classroom today to take forward your understanding of the Dow trader process.